My name is Nick Lamparelli. We're going to jump right in. And who am I speaking with today?
Hi, everybody. Today I'm really honored to join the podcast. My name is Itay Ben Zaken. I'm the co-founder and CEO of Honeycomb Insurance.
And what is Honeycomb Insurance?
Honeycomb Insurance is a pioneer in real estate insurance, particularly innovating in the multifamily property insurance space. We're the first to introduce a 100% digital experience to both customers and brokers, and powered by a very deep underwriting engine that helps us write price, make things more transparent and more efficient.
Itay, can you talk a little bit about what makes multifamily underwriting, multifamily insurance complex? Anything that you can provide, but if you can compare and contrast it to, let's say, like homeowners or commercial property, what's special or unique about multifamily that, you know, it requires a company like yours to get started?
Yeah, and that's one of the very things that attracted myself and my co-founders to really dig into multifamily as we were looking around at a few different potential insurtech ideas. It's kind of a bit of a perfect storm, or kind of the worst of all worlds for underwriting, because it's commercial lines on one hand. So commercial lines traditionally is always slower, more underwriter driven, a lot of manual review, and for a good reason, because these are big policies.
Yeah, the exposures are more complex generally.
Yeah, it's more complex exposure. If you compare it to homeowners, I mean, the TIVs, the total insured values that we deal with, are about 20x bigger than the average home or single family home. So, you know, you definitely want to be spending more effort or deeper underwriting to to work in this business. On the other hand, you're not insuring the Empire State Building, and 60 or 70% of the business in multifamily, you're underwriting, it's a $4,000 to $7,000 policy. It's $2 to $3 million, $4 million TIV. So the amount of time that you as an underwriter can dedicate to this is not unlimited. And that's what makes this market so interesting for digital disruption, because if you don't dedicate enough time, you're losing money. You're going to be losing money because it's a complex underwriting mission. If you're dedicating too much effort, then you're making things slow, and you're also narrowing your margins. So you really have to find the right balance of making it precise, but also leveraging new types of technology to not have to spend 2 hours of an underwriter on a risk just for quoting, because it's just not cost effective. And that's really what brought us to this market, because we said, okay, that makes a lot of sense for digital disruption, leveraging some of these technologies that have really advanced in the past 5 to 10 years, particularly around computer vision and artificial intelligence on imagery. And that's a lot of what we're doing. It's a lot of our secret sauce, where we're saying, okay, we're going to start from everything that property insurance has learned in the past 150 years. And that's really important stuff. That's the starting point. And then we're going to augment it, or start replacing some of those tedious tasks that are currently still done by humans with algorithms, with data that's available, that needs to be brought from distant and segregated silos and cleaned up and input into a system that can do it in real time. So all of that together is what I think makes this market very unique and very ripe for digital disruption.
Yeah. Can you talk about imagery? I've been seeing a lot of activity. There are a lot of players providing really not only high quality imagery, but adding the necessary software with machine learning and artificial intelligence. Can you describe a little bit on how you're using it?
Yeah, and there are some really great providers of data from both satellite and the ones who actually own fleets of airplanes and fly and periodically take really good pictures of the big cities. And there are good players that take that and create a layer of interpretation on top of it. providing scoring for different types of things, including for insurance purposes. So we've looked at a few different options, and I think I have a lot of appreciation of what these other companies are building. But for our purposes, because we're in a market which is, it's less cookie cutter, it's less standardized. A lot of the solutions that are out there, they either have something that fits single family because it's a bigger market and it's more advanced in terms of when it started moving forward in digital disruption. So what we ended up doing is we did end up building our own stack of technology with the leadership of Dr. Nimrod Sadot and Dr. Dror Letterman, who are leading our technology and AI practice. And our solution basically focuses on those key elements that for real estate multifamily property underwriting are the most critical. So it starts from the roof, but these are typically different roofs compared to the ones you find in single family homes. Single family homes, you have a lot of tiles. You don't have a lot of equipment on the roof like you do have in multifamily. You have air conditioning. In many cases, you apply a kind of a cookie cutter algorithm, the air conditioner will appear as a defect. You have a lot of pulling and ponding on those flat roofs. So we did want to make sure that our algorithms know to identify those key elements of risk that are critical in our space. Same thing with side view imagery, street view imagery. So we have these types of algorithms that can take a look at the building, count the number of floors, identify the type of construction, identify vegetation, identify quite a few things that are pretty specific for multifamily. And we could have gone to one of the vendors and said, okay, well, we need that. And what we've heard from them is that, well, we can do it. So because it's in our DNA, it made a lot of sense for us to build it from the ground up. And this way we also control and we can be as quick as we need to bring a feature or to bring something that basically is required in the underwriting to market as quickly as possible.
Are you using the different elements of your digital underwriting? Could you walk us through how you use it? You don't have to get into like the actual specifics, but I'm thinking more of like proportion, like how much of your technology helps with risk selection? How much helps with getting a rate, or how much helps with how much capacity you want to provide? So I guess a simpler way of doing it is, how did you use the technology to make some of the key underwriting decisions and kind of move something along in a way where you could take some of the human element out of it?
Yeah, so I have a lot of appreciation to the human element. I think eventually humans are much smarter than AI algorithms for at least a couple of decades. And so what we did is we actually took those elements that we've seen humans do repeatedly, that are decisions that are relatively standard or could be clearly defined to a machine, like, is this metal or plastic plumbing? Is this an old or a new electrical panel? Do you see rust on the water heater? Things like that. Versus more complex problems that I think are still a challenge. If you're trying to define to an AI algorithm pride of ownership or upkeep from a picture that has 15 different features in it, it's tough. So what we're doing is we're saying, okay, we take those atomic pieces of decision making and underwriting, we clearly define them, and then we can build a model to really provide this decision in real time. There's no 100% replacement for human underwriting judgment, but you can really narrow it down to not have to do it 100% of the time. So if the human underwriters have to deal with 0.5 or 2% of the cases that are really complex, then you've created huge value in margin and in efficiency. And that's kind of been our approach. The simplest things, just counting the floors, right? I mean, that's something that some underwriters are still doing. They're getting a commercial real estate risk, they're opening Google Street View, they're saying, oh, there's 3 floors here, it looks like wood, and the customer has said it's masonry. those things are very easily teachable, or maybe not that easily, but easily for AI experts. And these are things that we're using because in many cases you cannot not realize how some of the simple things are hurting insurance carriers. There's a Verisk study about premium leakage in commercial real estate, just based on misclassification of type of construction and square footage. And you're talking about billions and billions of premium leakage, because it's very cost ineffective to verify, right? So people say it's wood, and in 30% of the cases, or people say it's masonry, and in 30% of the cases it's wood. So you're underpricing by 20 or 30%, and you're still insuring the risk.
Right.
So some of those simple things that, imagine you could just take a human underwriter to do an unlimited amount of simple tasks, and we do it at 0% variable cost. I think that's the gist of what we're doing here that's so unique.
Could you talk about your particular for habitational, what you're targeting, both in geography and let's just say like what would be like an ideal habitational account to come across your desk?
Yeah, so geography-wise, we started from Illinois. We're expanding into another 6 states this year. So I imagine that pretty soon we will be in the, most of the U.S. states with big habitational proportions. In terms of the classic assets, I mean, we try to cover anything. I think that the idea is that we're right pricing. I think the old school approach was, or the approach that underwriters who didn't have a lot of data sophistication had to take, is we price to somewhat of an average. We augment this with human underwriting for declinations, mostly not for right pricing, and we decline a lot. We have a very narrow defined underwriting appetite, no small buildings, no swimming pools. Like, this is what has been most profitable for us, and that's what we're doing because we're not trying to grow. I mean, if you're an incumbent. For us, it's the opposite. I'm trying to decline as few risks as I can. I mean, we do have to end up declining maybe 5 or 10% sometimes of very unique and peculiar risks that we can't absorb. But we really are trying to do it through the right pricing engine. It's a little bit, it relates also a little bit to your previous question, when you started saying, well, is it more about risk selection or more about right pricing? To us, it's kind of the same solution, right? If I'm right pricing very precisely, then I can give a discount to those properties that are much better maintained that the others who don't go as deep as me are not doing. So I have a competitive advantage to winning that business. And on the flip side, those assets that I believe are worse than the average, I mean, they should pay more. I'd love to have them, but there's a price for any type of risk. And that's the mechanism that's been really working for us for risk selection, because it's automatically selecting against the problematic risk. And if there's a certain risk that is higher than the average and is having trouble finding a home, which is very common in habitational, we're happy to take it, but at the right price.
Yep. So a couple of quick questions. Is this an MGA structure?
Yeah, so we're an reinsurance-backed MGA. We've been live since end of June 2021, and growing relatively quickly. We've seen really great adoption from both brokerages and individual customers, and our aspiration is to expand to the 50 U.S. states within the next 2 to 3 years.
Excess lines are admitted?
Yeah, so we're working admitted. Our fronting carrier is accredited surety and casualty. They've been an amazing partner for a lot of things that we had at the beginning, and they've provided great advice from their long-standing history of running MGAs. So definitely happy to have this great partner on board for this journey.
Why did you choose Illinois as your first state?
So Illinois was a good combination for us of file a new state where you can move in quickly, relatively moderate catastrophic exposure, and a good enough size of market. I mean, you have, it's not the biggest state with habitational risk, but it's one of the nicer ones.
You got Chicago.
Yeah, Chicago is great. And again, Illinois is not as big as California, Texas, or New York, but regulatorily it's also a little bit quicker. Same thing, we just launched in Arizona last week, so Arizona is a little simpler, similar, but also even simpler from the cat exposure. Cat exposure is super low there, and it's also filed a new state, and it has good volume. We're eventually going to roll into the bigger states, hopefully even by the end of this year. Depends on the approval cycles. But we're seeing, I think, more similarity between those states. There's the unique angle of underwriting here is really around the catastrophic exposure, and that's why for us, as an admitted program, we're probably not going to roll into the more extreme weather states too quickly. I mean, we might do it on a separate program that's E&S. But I mean, one of the other innovation frontiers that we're already thinking with our development team and with our scientists who work at Honeycomb is how do you start creating an innovative framework for the catastrophic exposure? Because what we're seeing is that the old models are not going to survive. The old models are kind of, they're based on, one in a 500 year, one in a 1,000 year type of events. And we're starting to see those 1 in 500 year events every year in California. So I think we're not the only ones in the industry thinking about that, but I think for habitational particularly, it's going to be something that will serve as a really deep foundation, in addition to the attritional risk that I think we're doing best of the market. But in terms of catastrophic exposure, it will give us another edge, and it will allow us to roll into some of the more extreme weather type of states like Florida or Louisiana.
Yep. Can you talk a little bit about your direct to consumer strategy? You don't see that a lot on the commercial line side, right? Because it's a more complex sale. There's more going on. There's potentially someone who's specifically responsible for being an insurance buyer. So the marketing to find that person to get in the door is more complex. Can you talk about D2C and how you've thought about that?
Yeah, so I'd say we're omni-channel in our approach, and the leading thought here is I want to serve 100% of the customers, and I want to serve them in the way that they want to be served. So we have younger audiences, younger homeowners, early adopters, and they are starting to, get in. They're becoming a bigger chunk of the home ownership and the landlord landscape. And these guys are used to doing everything online. So I want to be able to serve them. And that's particularly true for the smaller policies. Sometimes these would be $2,000 policies, San Francisco 4-unit condos. I mean, it's not a huge policy. And these guys are, used to doing everything online. So if we serve them through the direct channel, that's a competitive advantage versus everybody else who's like, well, this market has been going through brokers, we'll just do it through brokers. So we took it a step further. I think the other piece is that we are direct marketers in DNA. That's what I did for many years. And it's weird for me to, market something just through channel, although the channel has been tremendously helpful in our situation. And I think the channel makes sense here for the long term. I mean, again, these are not tiny policies. Sometimes, you're buying a $7,000 policy. You've had a broker who knows you, knows how you think, who knows how risk averse you are. You want to get the broker's advice. And that also offloads a lot of the work from us. I mean, if we had to do 100% of the market direct, that would be a pretty big undertaking. So I think I kind of like that balance. And we've seen really great, responses from our customers. There are, it's interesting to see, because some people were like, well, I want to talk with my broker. I want to get my broker's advice. But some people would come in, and when we actually try to call them to, just figure out a little bit more about who they are, what they're looking for, they're like, well, guys, I came to you because you're online. I want to do it online. I don't want to talk with anybody. Just let me run my process. And I think that's the beauty of being omnichannel, is that you could actually provide that unique experience to the key segments by their preference.
Yeah. So what was Itay doing? You kind of hinted at it with some direct marketing, but what were you doing before Honeycomb? And follow up to that is what brought you into InsurTech?
Yeah, so I've been doing a variety of things in my career. I started my career in the Israeli military as an intelligence officer. Really interesting experience that I can't talk a lot about, but has taught me a lot of interesting things that have carried on with me to the next phases of my career. Then I studied computer engineering, worked as a software engineer at Intel, moved to the US, did my MBA in 2006, and worked as a strategy consultant for BCG for a couple of years. And then I actually got introduced to the insurance world when I joined QuinStreet, which is based in Silicon Valley. At QuinStreet, I ran basically their online insurance business unit. It started with the acquisition of insure.com, and then I moved on to acquire insurance.com and carinsurance.com to form the overall portfolio of about $100 million of properties. And I did that for 4 years, and I really liked insurance and direct marketing in insurance. That's one of the foundations of what I bring into Honeycomb. Then after I left QuinStreet, I started a marketing company called Comprendi. We used artificial intelligence and big data in a different type of capacity, but a lot of the thinking of how you use big, unclean, raw data to create insights is something that did carry on with me into some of the ideas of what we're doing at Honeycomb. And in 2018, started a think tank together with a Wharton professor friend, Professor Ron Berman. I knew I wanted to build an insurtech company because, again, I had a great experience doing insurance, running an insurance business unit at QuinStreet, and insurance was really starting to mobilize towards data-driven innovation, which data-driven innovation is something I did in my previous company. So it all came together, and we explored a few different markets that Ron had actually a personal experience with, being on the board of an HOA, and I had a personal experience with other products, and eventually that type of policy for kind of medium-sized commercial or small to medium-sized, specifically around habitational, with the size of the market, the way the distribution was structured. And after we discovered how basic the price modeling was, just made a lot of sense for us that this is our next thing.
Yeah, no, that's really interesting. How do you think you use your military intelligence background in solving problems around uncertainty? So it, in hindsight, seems like a really good fit, right? Like you're basically puzzling pieces of disparate data together to get to a solution. How much influence did your intelligence background have? Like, would you be doing what you're doing today if you didn't have that intelligence background and you were in some other division in the military?
So I think I would probably be doing this even if I hadn't been exposed to that type of thinking. But I think it does definitely help because, as you said, putting together an intelligence picture, whether it's of your market segments or whether it is of your competitors, or how you put your innovative product to gain a competitive advantage, is it's an intelligence analysis task. And that's what I did in the military. It's really taken a lot of different information pieces, very partial, some wrong, and putting together something that is telling a cohesive story or creating a cohesive experience. And that's kind of similar to leveraging data sources for underwriting insurance, because in many cases you have some data sources the industry has been using and everybody's oh, we can trust that, but maybe you don't know, maybe they're actually wrong, maybe they're off, maybe you're pricing masonry 30% above market, but the landscape has changed. So I think one of the things that I did learn is always to be looking for the data pieces that you can verify, and not to wait for the perfect information. You're never going to have perfect intelligence. You're never going to have the perfect information about your competition or your market. So to collect as much as you can, to kind of get to that 80-20 type of zone. But once you get the 80, be bold enough to make a bit of a bet so that you can move quickly.
Yep, that's our whole business. Like you encapsulated it in a nutshell, and I feel very passionate that we've deviated significantly from that sort of thinking. I find it very frustrating when people are looking for absolute certainties, like this will happen or this will not happen type of thing. And the world doesn't operate that way. You have to think, as Annie Duke says in her book, you have to think in bets. How much conviction do you have? How much bet are you willing to make on something? And to me, insurance is more like poker than a lot of other industries.
Yeah, I mean, I think the beauty of it is that in the absence of perfect information, if you do have information that's not just random and you're using it correctly, then even if you make mistakes, I mean, just like the loss ratio, right? If you had the perfect information, you'd have 0% loss ratio, right? Potentially. But, as you're managing things to make more right decisions than wrong decisions, then you see the wrong decisions in hindsight and you try to correct for them in the year, then you can make advancements while still making bets, as long as you make smart bets.
Yeah, I think about it as like the airline industry, more around we're in the really safe phase of airline industries, like knock on wood, like it's just magnitudes more safe than driving a car or anything like that. Well, how did that happen? Well, every time there was a mistake, there was a big bit of discovery on why that mistake was made, and then corrections were made. And if you keep doing that, you move, it goes beyond resiliency. I like to use the word antifragile. The system gets stronger and stronger. And it is part of a pet peeve of mine when I look at the industry. It's like that mindset does not necessarily exist. So people will talk a good game, but usually, like, once that big claim comes, it's like, oh boy, let's just pack it up. We can't make any money here, instead of trying to learn from it. I think that's a really good philosophy to have. I have one final question, which is the name of your company, Honeycomb. Can you talk a little bit about where the name came from? It in a philosophical sense, it seems like a perfect name. If you think about a honeycomb and what it does, can you talk about where the name came from?
Yeah, so we started our company, we used to be called Agilius, which is a name that I liked a lot because it really represents our agility and a very core element to what we do. We did find out that not everybody kind of knew how to pronounce it, and it wasn't very memorable. So when we launched our MGA, we went through a rebranding process together with a really great branding agency. And Honeycomb was the name that all of us really liked because it had multiple angles of why it made sense. First, it's the home of the bee, who's a very hardworking animal that we admire. The shape of a honeycomb looks a little bit like multifamily property, if you think about it. And it's a very strong foundation of nature. Carbon is, and a lot of other elements like natural foundations in nature are honeycomb shaped, by design. So it made a lot of sense for us, and it's more memorable. So that's how we ended up with this. We had a few other names that we really liked, but this one was the one that everybody was kind of, oh, I got it.
Yeah, I love the name. It is really fitting, and there's a positive connotation with that. I think and you kind of have to have that when you're pitching, when you're new, right? You can't have anything negative kind of cross person's mind. So I love the name. Really enjoy the concept. Itay, thanks so much for coming on and explaining Honeycomb and multifamily insurtech.